Hey guys, welcome to DevTech Finance, and this video we would be talking about the leverage analysis in financial management. So let's get started and try to understand what leverage actually means. Leverage refers to the amount of debt a firm uses to finance assets. So whenever a business is going to be started, there is requirement of certain assets for it. There is requirement for a building to be built up where the businesses would be run. So certain fixed cost is always involved in a business, and these fixed costs, their existence gives the rise to leverage. Leverage is a kind of debt or risk involved in the business. We will see how leverage affects the business, how it magnifies various profits and losses which occurs in the business. It is an investment strategy to use borrowed money. So whenever the business is going to be started, there is required of a huge capital to be invested in it for the basic starting, for the basic beginning of that business. So all those fixed assets which are acquired by these borrowed money gives a rise to the leverage. Leverage in a very simple terms means the debt which is because of the existence of the fixed cost. If a business is leveraged, it means that the firm has borrowed money to finance the purchase of assets. All those assets could be machineries, equipments, the tools and the basic infrastructure, the buildings, whatever is required, the offices. So all those assets which are the fixed assets, the assets that are fixed in nature, which do not vary with the number of units produced, which do not vary with the production, whether you are making 100 units of product, whether you are making 1000 units of product, the fixed cost would remain same. And those fixed costs, if that exists in business, and the capital is involved in it because to acquire those fixed assets, then the business is leveraged. And higher the fixed cost, higher is the leverage on the business. With larger presence of fixed cost, profit margins can really get squeezed when the business scenario is not favorable and the sales fall. This adds risk to the stocks of such companies. Okay, so we will see how fixed cost affects the business. It magnifies both the effects either on the profit or on the loss because of the presence of fixed cost. And why it is effective? Because fixed cost is an amount which is a larger amount which you are investing in your business to start your business, to run your business for a longer period of time. Variable cost would depend on the units of production being made, but fixed cost would be the basic building block of your business. And conversely, with the same larger presence of fixed cost, company would experience magnified profits with increase in sales as the cost level remaining constant. So we would look after and try to understand how the existence of fixed cost affect profit margins, or how it magnifies both the effects either on the profit or on the loss in the business. Try to understand this scenario. I have taken two cases, case 1, case 2 and case 3, where the revenue for case 1 is 15 lakhs and then it increased to 21 lakhs in the case number 2, and then it decreased to 12 lakhs. So what happened? If you look at the percentage change in revenue, so from case 2 we have seen that the revenue has changed from 15 lakhs, it has increased to 21 lakhs. So there is 40% changes revenue. Whereas when we talk about case number 3, the revenue decreased to 12 lakhs. So there is a negative 20% change in revenue. Now we would try to understand how this change in revenue has impacted on the profit, and why it has impacted because of the presence of the fixed cost. So this is the fixed cost 10 lakhs rupees, which is remaining constant in all the cases. And by deducting fixed cost from revenue, we are arriving at profit, assuming that there is no variable cost in the business. So just see the percentage change in profit because of the change in the revenue. So when 15 lakhs, we deducted the fixed cost of 10 lakhs, we got a profit of 5 lakhs, and likewise for case 2 and case 3. So see, the percentage change in profit. In case 2, it has been 120%. From 5 lakhs, it has raised to 11 lakhs. And thus we got 120% change in profit. While in case 3, we have got a negative 60%. That is loss, 60% loss. And just you can see the impact because of the presence of fixed cost. We can see that for 40% change in revenue, there is 120% change in profit, almost 3 times. And for 20% loss, because of the presence of the fixed cost, there is 60%, sorry, for the 20% loss in sales, which is going negative, so there is 60% loss. And you can see this is also almost 3 times. And why this is happening? Because fixed cost, there is presence of only fixed cost. And this is magnifying the impact. So if the condition is favorable, like if there is positive 40%, our business is doing good because of some reason, the sales are increasing, we are doing well with our marketing strategies. So the presence of fixed cost would magnify the impact of the profit and we would get a better profit. But in any condition, if the economic scenario is not favorable and our business is not doing good, so it would result in a magnified loss as well, where we can see we are getting negative 60%. Now the types of leverages. We can classify leverages into operating leverage, which arises because of the presence of firm's fixed operating cost. Operating cost could be the salaries, the rents, because these costs are fixed in nature. These are to be paid on the monthly basis on a fixed amount unless there is any changes being made. Depreciation, which is charged on any of the fixed asset on annual basis or monthly basis. Then there is utility expenses like electricity, water charges, etc. All these expenses which are fixed in nature give a rise to the operating leverage because these expenses need to be paid. They are compulsory to be paid, independent of the variable cost, independent of the production being made in the business. These are something which is compulsory, which is obligatory in the business to run the business. Thus it gives a rise to certain amount of responsibility on the business. It need to be paid. That is what the basic concept of leverage is. When we talk about the financial leverage, it arises with the presence of firms' fixed financing cost, such as interest expenses on debt and preference shares. So if the firm has borrowed money either through loan or preference shares, it has to pay certain interest on that on a fixed interval of time. So this interest expense also gives rise to leverage because we are paying it on a fixed interval of time, and it is obligatory for business. It is fixed in nature, which is occurring, which is reoccurring, and this is creating a debt on the business. That's what basically leverage means. And then there is combined leverage, which is product of operating and financial leverage. So it would give an overall leverage picture, whether in the terms of operating or financial. It will provide a total view of the company. Let's see some of the formulas. So we would be using these formula to calculate the degree of operating leverages, degree of financial leverages, and degree of combined leverages. So just try to understand. It's like sales minus variable cost would give you the contribution, and when you deduct fixed cost from this contribution, we would be arriving at earning before interest and tax. This earning before interest and tax is also referred as profit before interest and tax. Then we would deducting the interest out of it, and we would be arriving at earning before tax. We can call it as profit before tax as well. Earning before tax and deducting tax out of it, we will be arriving at earning after tax or profit after tax. That is also referred as PAT. And then we can calculate the earning per share, which is the earning after tax divided by the number of shares issued. So what we are doing, we are just deducting both the cost, that is variable cost or fixed cost, from our sales, which is the source of our revenue, to arise at profit. And then we are deducting our fixed financial leverage, that is interest, and then we are arriving at EBT. After that we are giving away all the taxes and we are arriving at the net profit of ours. Out of that net profit, what we are giving to our shareholders is earning per share. Let's see the formulas for operating leverages, financial leverage, and combined leverage. So degree of operating leverage is contribution by EBIT. This is how we calculate. And operating leverage would give us a view how our business is going, how our business is leveraged. Is it okay or is it too much in the debt? Degree of financial leverage would be equal to EBIT divided by EBT, and degree of financial leverage could also be calculated in the percentage terms like percentage change in EPS by percentage change in EBIT. Degree of combined leverage would be product of operating leverage and financial leverage, or you can use the formula of percentage change in EPS by percentage change in sales. So now try to understand, because of the change in sales, how much you're earning, how much your profit is being impacted. That is what degree of operating leverage is signifies. And because of the percentage change in your earning, what is the percentage change in the earning per share, that is the earnings for the shareholders, what is that because of the change in your profit? So that would be shown by the degree of financial leverage. And at last, the degree of combined leverage would show that how percentage change in sales is impacting the earning per share. Earning per share, which is your final point where the profits, whatever you are having, the net profit, that is what we refer to, which can be paid to the shareholders or could be invested in the business for further improvements. So I would be talking about all the types of leverages in my upcoming videos in details about the operating financial or whether the combined leverage. I would be dealing with examples of all those leverages. Thank you for watching. Do like, share my videos and subscribe to my channel DevTech Finance. Thank you all. Keep a track to see more upcoming videos and thank you all.